Social media has meant it's never been easier to start up a new brand and to build a following online. And what that's meant is you get all these now challenger brands that have popped up and started to advertise through social media, build a following, and essentially start eating the lunch of some of the traditional big brands. I guess the thing to look at is what is the degree of exposure to these risks. And obviously it's actually a category by category and geography by geography analysis that we sort of go through. So what is the degree of, their product suite that is sugary or processed? What is the degree of what we call fragmentation taking place in the categories? So that means how much are challenger brands actually taking share? And in some categories, challenger brands have been taking all the growth away from these big brands. And then of course, we can also look at examples around the world. Amazon is still primarily a US phenomenon, and after buying Whole Foods in 2017, their push into grocery is still very much so far a US-based risk. So what we've done is we've looked at, for example, Europe, which has the highest private label penetration in the world. That's been pushed by the Aldis and the Lidls of the world, and of course the UK retailers as well. And we can look at the example of China that has among the highest online grocery penetration in the world. And it gives you sort of a bit of a guide and a goalpost as to what the degree of impact could be on any individual US-centric company or even a global multinational in terms of the degree of impact. But what you've seen, in the China example is that, there's this concept of when you go online, there's an infinite aisle, and you can have thousands and thousands of products available to buy. But if you think about your own behaviour, who goes past page 1 of Google? People just look for the top 2 brands. Generally what happens is, and what we've seen in the China example, is brand number 1 and brand number 2 actually have higher market shares than they have in other parts of the world. And it's brands 3, 4, 5, 6, 7, 8, 9, 10 in terms of relative ranking that actually get killed in that situation. Number 1 and 2 tend to consolidate market share around themselves. And then of course you have the private label alternative. So to give you an example, Nestle, it's a global multinational business, but it has 70% of its sales where it is the number 1 and 2 brand. And its average market share is sort of 30%. It's twice as big as its competitors in general in the categories that it operates in. And that means it has more spending power as well. On the other hand, you have, and then the categories that they're exposed to are quite important as well. So they're in, high-end chocolates, they're in coffee, which they've just strengthened their alliance, strengthened their position through an alliance with Starbucks. They also are in infant nutrition, which is a very brand-heavy category as well. And you compare that, I think it's sort of worth comparing to something like a Kellogg, which has only 37% of its sales where it's the number 1 and 2 brand. And even within those categories, it's no bigger than its competitors in terms of spending power. And then of course, the big issue facing a company like Kellogg is the categories that it's in. This health and wellness trend is an incredible burden for them to overcome because people have moved away from buying sugary cereals and snacks. And of course, that business is trying to adapt in making, snack-sized versions of the products they used to sell. But you can imagine that this is incredibly difficult for that business to grow, given the hurdles that it's facing and given its relative market position. So that business, for example, in the recent reporting season, just optimistically said, we're hoping to get 0 growth in the next few years. And on the other hand, you've got this other business like Nestle, on the surface of it, both of these companies have what you would call strong brand portfolios, brands that everybody knows and loves, but their future prospects actually look very, very different. And I think the implications of that are, would you pay the same price for a Kellogg versus a Nestle in terms of multiples? Of course you wouldn't, because those prospects looking forward are so different.